This set of slides is on how behavioral finance influences market behavior. Much of the day-to-day work of investment professionals will be within the framework of efficient markets. Even though the understanding of market efficiency has been broadened, it still does not explain some persistent market patterns. Behavioral finance does offer some explanation of these exceptions to market efficiency, which we call anomalies. Anomalies, which are apparent deviations from the efficient market hypothesis, are identified by persistent abnormal returns that differ from zero and are predictable in direction. However, calculating what constitutes normal returns relative to the risk incurred depends on the asset pricing model used. Anomalous behavior can be indicative of shortcomings in the underlying asset pricing model. So if the anomaly disappears after changing the method, then the anomaly is an illusion. Some apparent anomalies may be explained by small samples involved, a statistical bias in selection or survivorship, or data mining that over-analyzes data for patterns and treats spurious correlations as relevant. An example is the Super Bowl indicator, which was from 1967 to 1997, 30 years. The Super Bowl indicator correctly predicted the direction of 2 out of 3 US market indices 27 out of 30 times. But then it indicated wrongly 4 times in a row, delivering an accurate result in just delivering an accurate result in just 7 out of the next 13 years. Since any correlation between the outcome of a sporting event and the stock market performance cannot be rationally explained, it is not surprising that the Super Bowl indicator has turned out to be an inaccurate predictor. Also, markets do present temporary disequilibrium behavior, unusual features that survive for a period of years but ultimately disappear. Publication of the anomaly can draw attention to the pattern and start the arbitrage that removes the behavior. For example, the weekend effect, which involved lower stock market returns on Mondays, appears to have reduced in the US and the UK. There's also momentum. So this is where future price behavior correlates with that of the recent past. Typically in the short term, which is about 2 years, there is positive correlation, but for longer periods the returns are negatively correlated and revert to the mean. Individual investors may make what they believe is a rational decision to imitate the decisions of others, but the sum of the individual decisions can be irrational behavior. Irrationality can occur in the form of herding, which occurs when a group of investors trade on the same side of the market in the same securities, or when investors ignore their own private information and act as others do. Anchoring, where investors' bias to sell winners reflects anchoring on the purchase price. The belief in mean reversion can cause investors to underreact to positive news, and stock prices to take time to reflect fully more favorable news or earnings updates. The availability bias or recency effect is where investors recall recent events more vividly and give them undue weight. Thus, they extrapolate price rises into the future. Regret or hindsight bias, where the feeling that an opportunity has been missed and that past events were predictable. This can contribute to overtrading and creates a trend-chasing effect. And the disposition effect is where emotional bias to loss aversion, and it encourages investors to hold on to losers, causing an inefficient and gradual adjustment to deterioration in fundamental value. There's also bubbles and crashes. So periods of significant overvaluation or undervaluation can persist for more than 1 year rather than rapidly correcting to fair value. The efficient market hypothesis implies an absence of such bubbles. Bubbles and crashes appear to be panics of buying and selling. A continuous rise in an asset price is fueled by investors' expectations of further increase. Asset prices become decoupled from economic fundamentals. Bubbles typically develop more slowly relative to crashes, which can be rapid. This asymmetry points to a difference in the behavioral factors involved. A crash would typically be a fall of 30% or more in asset prices in a period of several months. Some bubbles and crashes will reflect rapid changes in economic prospects that investors failed to anticipate, i.e. the global oil price shock of the 70s and the Japanese asset price bubble of the late 1980s, in which real estate and stock prices rose dramatically. Recent examples are the technology bubbles of 1999 to 2000 and the residential property boom of 2005 to 2007, evident in a range of economies globally, including the US, UK, and Australia. Note that sometimes there are rational explanations for some bubbles. Rational investors may expect a future crash. In bubbles, investors often exhibit symptoms of overconfidence, overtrading, underestimation of risks, failure to diversify, and rejection of contradictory information. At the market level, volatility also often increases in a market with overconfident traders. The confirmation bias or self-attribution bias or hindsight bias are that in a rising market, sales of stocks from a portfolio will typically be profitable, even if winners are being sold too soon, i.e. I knew it all along. Regret aversion is where it applies to encourage investors to participate in a bubble, believing they are missing out on profit opportunities as stocks continue to appreciate. The illusion of knowledge bias applies in that investors would be better off not trading on all the information available, which includes noise or non-relevant information. In a bubble, noise trading increases and overall trading volumes are high. As the bubble unwinds, there can be an underreaction that can be caused by anchoring when investors do not update their beliefs sufficiently. The early stages of unwinding a bubble can involve investors in cognitive dissonance, ignoring losses and attempting to rationalize flawed decisions. The disposition effect encourages investors to hold on to losers and postpone regret. And finally, value and growth. A number of studies have shown or identified outperformance of value stocks relative to growth stocks over long periods of time. Famer and French note that value stocks, which are defined as high book-to-market equity, outperformed growth stocks, which are defined as low book-to-market equity, over long periods of time, in 12 of the 13 major markets during the 1975 to 1995 periods. Famer and French also identified that small-cap stocks outperform large-cap stocks in 11 of 16 markets. Thus, they incorporate size and value in their three-factor CAPM. Irrationality can occur in the form of the halo effect, which extends a favorable evaluation of some characteristics to other characteristics, i.e. a halo is formed around a particular thing. For example, a company with a good growth record and good previous share price performance might be seen as a good investment with higher expected returns than its risk characteristics merit. And home bias, where portfolios exhibit a strong bias in favor of domestic securities in the context of global portfolios. It reflects a perceived relative informational advantage, a greater feeling of comfort with access to company executives that proximity brings, or a psychological desire to invest in a local community. So these are some explanations to market behavior that might be deemed irrational according to traditional finance, but have some explanation when we look at it from a behavioral finance perspective.